morning, everyone, and a heartfelt welcome to this launch of the 27-4 BE.conomics Annual Research Report 2022 results presentation. This is the 14th edition of the survey and certainly a highlight on the retirement funds industry agenda and our financial sector generally. Batseta, the Council of Retirement Funds of South Africa, is pleased to be a partner to this very important event in our annual calendar. The report is an excellent resource to gauge the progress made with our transformational priorities and constraints that impact Black asset managers and our retirement funds and our financial services sector at large. Creating a more equal society within our democratic South Africa has been on the national agenda now for decades, and BEE is central to achieving this. It is not only about the law, but also the spirit in which it's being crafted. In this respect, it presupposes financial inclusion, genuine participation of all role players, and real empowerment for our stakeholders. Yet, progress seems to be unhurried. The unintended consequence of this unhurried approach, whether intentional or not, is the tightening of regulation and the creation of a perception that some role players might not be genuine or honest in their transformation agendas. It also means that we tend to overlook good news stories and focus on the negatives rather than positives associated with our BEE journey. The 27-4 BE.conomics report provides a balanced view of what transpires on an annual basis. As I've indicated, it's an excellent resource to inform our transformational agenda and strategies and contribute to our decision making as leaders. Time is not always on our side. I want to echo the words of President Ramaphosa when he said earlier this year at the inaugural Black Industrialists and Exporters Conference in Sandton, when he said, there can be no inclusive recovery and reconstruction unless broad-based Black economic empowerment is at the center of our efforts. Important words there. The report will touch on the strides made with the development of the entire value chain and particularly gender parity in financial services. I strongly believe there's no shortage of innovative and competent Black professionals and service providers within our financial services sector in South Africa, and they must be given the opportunity now. I applaud 27-4 for the fantastic work they are doing and have done through the years in raising awareness and being at the forefront in championing transformation in our sector. We all have a role to play in making sure that there is meaningful participation of Black people in financial services and the retirement fund sector. Let's nurture and welcome everyone on board. Congratulations to 27-4 for producing another edition of our BE.conomics report. And ladies and gentlemen, Fatima Vauda will now provide an industry overview and delve deeper into the findings within public markets, and Rory Ord will cover key findings in private markets. A Q&A session will be held at the end of the presentation, and I'd encourage all of you to post your comments or questions in the Q&A box for the panelists to then address. Without further ado, let me welcome a true stalwart of our financial services sector, Fatima Vauda, Managing Director of 27-4. Fatima.
Thank you, Rajesh. Thank you so much for the extremely warm welcome. So good morning, all. Another year has passed since we last spoke, and we're really thrilled that you are able to attend this morning's session. So a very big thank you and a very warm welcome. Before we get into the results of the survey, I just want to take a moment to remind our audience of the critical role which our sector plays in facilitating the efficient allocation of capital to support economic growth and resilience. We know that for an economy to remain stable, it needs to have a healthy financial sector. And that ability to efficiently allocate capital, provide finance for investments, mobilize and pool savings are some of the benefits of a very well-developed financial system. However, for that financial system to be more resilient and enable it to sustainably contribute to economic growth and prosperity, we need to urgently address issues of inequity and financial inclusion. But these cannot be addressed without a comprehensive study of the factors at play. Has transformation BEE policy worked in our sector? Are the products and services we deliver generating value for our people? How can we play a better role? And how can our sector be globally competitive and attract foreign investment? So these are some of the key themes that I'd like to touch on as we go through the presentation. As indicated by Rajesh, I will largely focus on providing the sector overview, and then followed by which we will focus on the private markets component of the presentation. So I'm going to get straight into it on that note. If we move then on to the first slide of our presentation. So as indicated by Rajesh, this is our 14th edition of the survey. It is also the most detailed and comprehensive study conducted in the South African asset management industry, covering both public and private markets, drawing the attention of diverse stakeholders from policymakers to capital allocators to asset managers and to all of our peers in the sector. The depth and breadth of our data allows us to evaluate and measure not only the state of transformation of the sector, but also capital allocation patterns, the success or failures of policies and trends shaping the sector. This year, we bring you a 227-page publication packed with loads of insights and brought to you by an experienced team of industry practitioners. If we move on to the eligibility for participation in the survey, and we get quite a few questions around who is eligible to participate. I think the industry is fairly familiar with the criteria we use across the public markets. However, the criteria between public and private markets are different, with that of private markets being somewhat slightly more complex. And for that reason, I thought I could focus a little bit on the private markets criteria to highlight the elements that are different. Within private markets, there are lots of different definitions currently being applied when it comes to Black ownership and control, which makes it incredibly difficult to understand the full universe of Black private equity managers on a reliable basis. So, for example, some parties call themselves Black private equity fund managers if they have the minimum 51% Black ownership, while we, on the other hand, apply a much fuller definition of the financial sector codes, which includes the makeup of teams, the share of economics, the ownership of portfolio companies, as well as the ownership of the fund manager. In short, the criteria that 274 applies to Black private equity fund managers is a lot more stringent than the broader definition in the market. So that's largely for private markets participants. In terms of public market participants, those criteria appear on the screen and have not changed since inception of the survey 14 years ago. Moving on to some of the highlights. Since launching the survey in 2009, the assets under management has grown to 1.3 trillion rands. So that is 1,300%. You can see there in the top right chart, the total AUM in 2009 was 14 asset managers representing a total of 91 billion rands of assets. We're now talking about 61 asset management firms representing 1.3 trillion rands of assets, of which 33 billion of these assets represent that managed by Black private markets asset managers. The respondent universe also over the years has grown to include both independently Black firms, Black-owned asset managers at the outset, as well as those who have transformed over the years to meet our criteria for participation. There's been much debate around whether policy interventions such as the Financial Sector Code have made much progress. Having been at the forefront of transformation in the financial services sector for the past 2 decades, I can comfortably and confidently stand here today and say that without such an intervention of the Financial Sector Code, the concentration and inequity of the sector would still be extremely high. And the table on the right-hand side is a clear demonstration of the strides that have been made over the past couple of years. And what we can see in the table at the bottom, currently, there are 4 majority Black-owned asset managers managing more than 100 billion rands of assets. And there's been continuous progress over the years. As Radesh said earlier, we tend to focus too much on some of the negative aspects, and it's time that we also celebrate our successes. We recognize that transformation is happening in the industry. The data definitely supports that. But I also want to give a shout out to 2 of the fastest growing asset managers, Aluwani Capital Partners and Terebinth Capital. I mean, the growth of Aluwani Capital Partners has been nothing short of remarkable since inception of the business almost 7 years ago. And then Terebinth Capital over the past reporting period, in fact, grew 62% under the leadership of Nomatibana Matshoba. So let's celebrate some of the big successes that the industry has experienced over the past decade. Moving on to some of the policy interventions that has taken place, what we have definitely observed in this year's publication, that there's a definite sense of urgency to transform across the entire sector. And, we sat back and we asked ourselves the question, it's been very slow over 20 years, and why suddenly there's this rapid urgency to transform? Could it be because next year marks the 20th anniversary of the broad-based Black Economic Empowerment Act of 2003? Or could it be because of the multiple policy interventions, such as the Financial Sector Conduct Authority's draft strategy for promoting financial sector transformation, which will ultimately see the regulator playing a much more supervisory and enforcement role in promoting financial sector transformation following the promulgation of the Coffee Act, including some amendments that will be made to the Financial Sector Regulation Act. The urgency maybe could also be because of the Employment Equity Amendment Bill, which is currently sitting with the President for signature. And this bill could result in the Employment and Labour Minister implementing sectoral numerical employment equity targets. It's important to note that no financial services company in South Africa, Black, non-Black, are able to meet the management control target. And maybe this bill will ultimately result in that companies will begin to meet this target. Or could it be that the Financial Sector Code recently moved to disallow group reporting under the code, so that a more realistic reflection of the true state of transformation within the sector can be measured? From someone who has spent many years focused on understanding the drivers of inequity and inclusion within the sector, I'm fairly confident that whilst the needle has moved incredibly slowly, progress is being made, and this progress is clearly visible as more companies' levels of revenue has also begun to improve, as demonstrated by the chart on the right-hand side, which clearly shows that, for example, in 2019, only 17% of firms that are Black-owned were generated turnover of more than 50 million rands per annum. That has increased to 26%. There's also a lot more QSCs in the markets. So at 32% last year to 37% this year. And of course, the number of EMEs is declining, which is a good sign. So there are less businesses within the asset management industry that are generating a turnover of less than 10 million rands within the sector. What we also did in this year's survey, we wanted to understand what are some of the views and how are Black-owned asset managers responding to some of the big changes that have taken place in Regulation 28 of the Pension Funds Act, which governs South African retirement funds. And the recent increases we saw was the percentage of assets a retirement fund is allowed to allocate offshore was increased to 45%. And this year, we also saw the introduction of an allocation limit to infrastructure of 45%, which will become effective in January 2023. So we thought we need to dig deeper into how these two amendments impact Black-owned asset managers, but also how do they impact a retirement fund's liability-driven investment strategy. So you'll see we've got a question that was asked on the top right corner on how managers feel about the increase in Regulation 28's offshore limit, as well as how managers feel with regards to the increase in the infrastructure limit. And we also asked managers, what is the easiest way to access infrastructure investments in South Africa? And then, of course, considered a detailed analysis and study of the impact of both these changes on a liability-driven investment strategy of a retirement fund. So I'll just touch a little bit on the offshore side. This increase in limit has brought a lot of benefits, as well as highlighted some perhaps deficiencies within the market. The opportunity really provides a lot of local players to hone in more local skills in the management of global portfolios. Whereas on the other hand, the deficiency has really exposed some of the regulatory pooling restrictions we see in the South African market, which compel domestic asset managers to seek offshore jurisdictions for the registration of dollar-denominated portfolios, which ultimately result in feeder funds adding a lot of layering of costs. And closing this gap, we believe, represents a fantastic growth opportunity for South African banks, administrators, and other service providers in the value chain. And currently, we're taking all of that business and giving it to offshore service providers. What we've also identified is that the increase in externalization of domestic savings has also ignited corporate partnerships within the sector. So we know that Stanlib has now entered into an arrangement on the global side with JP Morgan Asset Management. And similarly, Alwani Capital Partners has announced a tie-up with Franklin Templeton. In the majority, most people believe that this type of partnerships is going to continue to increase across the sector. So we should be seeing more of these tie-ups happening. On the infrastructure side, there are multiple vehicles that have been identified by the sector through which retirement funds can access these type of opportunities and take advantage of the potential illiquidity premium of long-term real assets. And this policy change has really been welcomed by the sector, where asset owners have recognized the benefits of including this asset class into their investment portfolio. So the chart in the bottom left-hand corner considers the impact of these changes to retirement funds' LDI strategies. And what we demonstrate there is clearly that the regulation provides retirement funds with an expanded investable universe that can reduce its active risk in an LDI strategy, providing better income protection, and improved future pension outcomes. Whilst listed infrastructure bonds are already included in many liability tracking portfolios and will continue to be an attractive choice, we see infrastructured private equity funds, including unlisted debt funds, providing excellent investment opportunities to retirement funds that can also provide diversification benefits and, of course, improve more future pension outcomes. And Rory will touch on some of these areas later on during his segment when we talk about private markets investing. If we move on to one of my passions, which is financial sector strategy. And so what we thought this year, because people always say, we always do exactly the same as previous generations do. We don't disrupt, we don't evolve strategy because so-and-so has done it in that way. We're going to continue focusing on that type of organizational strategy. And so this year we included a section focused entirely on organizational strategy within the asset management industry. And what we found was that in South Africa, asset managers have adopted one of three models. There are those who offer the broadest range of products, who cater for a wide range of needs and who are subsidiaries of either the large banks, the life insurers, and access the distribution channels of these very well-established household brands. On the other hand, and they tend to focus, and I like to talk about active and passive in a way of alpha, being an alpha hunter or beta grazer. And these big firms tend to operate very large integrated businesses and can be both alpha hunters and what I refer to as beta grazers. Then we find asset managers with very unique skills and distinctive differentiating characteristics who are typically positioned as specialized alpha hunter boutiques. And these tend to be management owned and controlled. In some cases, they can also be partially owned by a large bank, insurer, or investment holding company. And a good example of such a shareholder is RMI Investment Managers, who hold equity in several boutiques and provide capital, operational support, and in some cases, even distribution to these companies. There is also the likes of Africa Rainbow Capital Financial Services, who in fact have a shareholding in 5 companies participating in this year's survey, who provide and confer Black ownership on their investee companies. Lastly, we also have that manager in the middle, which offers a range of capabilities across asset classes under a centralized operational and distributional multi-boutique model. So what we found is that majority of Black-owned asset managers classify themselves as specialized alpha hunter boutiques who generate distribution equally from direct client relationships, but also through working with intermediaries. We also often get the question that should Black-owned asset managers diversify across multiple products, or should they hone into their focused skill? And what we found is that the average number of products to be successful and optimal in the current environment and in the South African industry is 6 products. The product capability of 6 products seems to be the optimal level. Above this, you kind of reach a diminishing kind of value as opposed to optimizing value to clients. And below this, it really depends on ultimately the model that you follow. So this was quite a set of interesting findings that we got. Also, just given where managers play, which I thought was also very interesting, was if you look at the bottom left-hand graph, which shows the styles that managers follow in the domestic equity space amongst Black-owned asset managers. What we found was that following a flurry of style cognizant equity funds over the past decade, what we have now identified is that newer funds coming to the market are taking a different route. The bulk of new entrants to the survey this year, as well as incumbents, are launching equity strategies as now style agnostic. And maybe the shift is largely driven by a number of factors, but one of the key contributors has been the dwindling investment stock universe on the Johannesburg Stock Exchange, as well as liquidity constraints. And these conditions ultimately make it incredibly difficult for managers to strictly stick to one style of investing. Some have also been deterred by the cyclical nature of the different styles, which has historically led to prolonged periods of underperformance. So being style agnostic has allowed managers to rotate from one style to the other, depending on which one is in favor. And overall, most of the widely recognized styles are well represented across the respondent pool. In terms of any material changes to asset allocation patterns, what we did find this year is that there were no material changes in the composition of strategies offered by Black asset managers. Actively managed domestic fixed income and equity strategies remain the most dominant, accounting for close to half of total AUM. Money market assets declined in line with lower interest rates over the period, but should begin to increase given the recent and expected future rate hikes. Over the years, what we've also noticed is that managers have expanded their capabilities beyond the equity and money market space and have successfully grown capability in the fixed income space, which is now neck and neck with active equity strategies. Positive inroads have also been made in the multi-asset class space, but despite the increase in the allowable offshore limit to 45%, the total allocation to offshore assets, equity and other, is around 6.5%. So we asked asset managers if they thought that South African asset managers have the necessary skills to meet the demands of domestic investors' global allocations, and 91% of respondents said they agree with that point. They also believe that South African asset owners should adopt a more South African-centric approach when it comes to global allocations. And they also think that we will continue to see tie-ups between South African asset managers and global investment managers following the increase of the regulatory limit. One of the areas that Black-owned asset managers find to be the Achilles heel in the market has been gaining access to distribution channels. And so this year we really tried to dig deep into what are some of the obstacles to gain access to distribution channels. And we know that in our sector, whether you're an asset manager that is large or small, everyone needs access to distribution. And distribution makes it one of the most critical business success factors. Only a handful of asset managers successfully gain access to distribution partner channels, rendering the direct-to-customer channel the most feasible option for most asset managers. As in previous editions of our survey, standalone institutional funds remain the largest source of assets, despite the shifting sources of investment capital. So on the global side, if we evaluate the flows between retail and institutional flows, we find that retail flows have consistently been higher than institutional flows, as asset managers globally have in fact embraced and leveraged advancements in technology, data analytics, and have made retail investing a lot more accessible to the man in the street. A continuous frustration by this cohort of Black-owned asset managers has been that only 2% of all participant products are accessible on umbrella funds. It's no surprise that majority of respondents hold the view that commercial umbrella funds continue to largely cater for the distribution of sponsor-managed products. And this is also not only the view that is shared by Black-owned asset managers. The National Treasury on 14th of December 2021 released a paper for comment titled Governance of Umbrella Funds, wherein it states that while some multi-employer funds appear to be well run, the National Treasury is concerned about the governance of others and the consequences of poor governance on member outcomes. Some of the governance challenges include the overdependence of board members on product and service providers for advice and conflicts between loyalties to members and to those who elected or appointed the board members. The rules of some funds also constitute an impediment to sound fund governance, management, and administration because they tie the funds to specific service providers. Some rules even compel members to remain enrolled in those funds when they and their employers are convinced that better value for money can be obtained elsewhere. So the spotlight of the government on commercial umbrella funds means that there's now heightened security on governance, complex and opaque fee structures, and service provider restrictions. So the industry continues to be hopeful that this review by government will make it easier to break down the gates that currently hold back fair participation in the umbrella fund space. On the global front, what we have identified is that there are now close to 800 non-rand denominated pooled funds, mostly UCITS compliant, registered in offshore jurisdictions, available for sale to retail and institutional investors in South Africa. Asset managers with global clients tend to opt for global jurisdictions, whereas those only focused on catering for domestic needs tend to register their funds in South Africa. But this also, the bottom left-hand graph also speaks to the low number of funds which have registered hard currency portfolios, and maybe the domestic shift of capital will see an increase in fund registrations on the global side. But if we have to look at the preferred jurisdictions by South African asset managers, it seems that Ireland continues to be the preferred jurisdiction, with Luxembourg recently entering that fold. The growth in the unit trust industry has grown fairly significantly from 40 unit trusts in 2014 to 151 now. And also we've got around 30 asset managers that now manage these 151 unit trusts. Whereas unit trusts were previously only for retail investors, what we have also noticed is that unit trusts have become fairly entrenched in the institutional market and now comprise a large component of assets under management in the unit trust industry, as many institutional investors are beginning to move away from segregated mandates to pooled mandates, and unit trust pricing has become a lot more competitive and cost effective. Moving on to the brand messaging focus of asset management firms, we really challenged managers on topics such as brand equity to identify whether brand equity and financial performance are mutually exclusive or not. Given that there is sufficient empirical evidence linking brand equity to the financial performance of a business, what we found is that many businesses do not focus enough on brand value. Interestingly, we found that social media advertising declined over the period, despite the mammoth growth in this medium of advertising. We also found that managers do not make use of data analytics to understand customer behavior and to aid targeted messaging in the retail sector. At the end of the day, out of sight, out of mind, asset allocators and advisors are regularly running manager searches. So asset managers, we feel, should prioritize communication with different market segments. And most importantly, that messaging should be adaptable to those different market segments. For emerging asset managers out there, messaging is very, very important and should focus on strength and differentiation. People want to understand why you, why us, what makes you different. The bottom line from this year's survey is that companies spend too little money on brand messaging. And we would recommend that emerging asset managers in particular look at increasing their annual spend towards brand messaging. I just want to touch on ESG. As you know, 274 publishes an annual ESG survey, and that really covers a fair amount of information on ESG. But touching on a couple of key components, our industry now recognizes the multiple frameworks at play that can be used to guide the disclosure of sustainability issues. Also, the JSE recently launched its sustainability disclosure guidance document, which is also based on double materiality, because often we are asked this question: should companies focus on only financial materiality or impact materiality? And what we have found is that 93% of respondents to the survey define materiality as both financial and impact. Only 7% of respondents focus on financial materiality or the impact of ESG factors on enterprise value. That's been a positive development. Over the years, we've also focused on identifying the level of ESG integration across the different asset classes and investment strategies. And what we have found is that consistently listed equities continue to report the highest proportion of respondents that believe that they achieve high integration. Only 11% of firms that manage listed equities reported low or no integration. And like in 2021, the weakest asset class in terms of ESG integration is sovereign debt. Only 27% of respondents that manage this asset class reported high integration, while 38% reported low or no integration. With sovereign rating agencies beginning to increase the integration of ESG factors into their models, we're hoping that the situation should improve in the years that follow. And then lastly, we also asked managers which is it the G, the S, or the E that they consider the most important. And whilst all of them gave each one very, very high scores, G came out right on top, followed by social, and lastly, environmental. But there's a lot more depth in this section in the actual survey. Gender lens investing, another big hobby of mine. And in recent years, there's been a big focus on driving the diversity of boards and executive leadership. Unfortunately, the chart on the left-hand side, the bottom left-hand side, shows that women in general are underrepresented in leadership positions, C-suite positions. In the asset management industry, we classify C-suite as CEO, CFO, CIO, or head of the investment team, or the head of the head of distribution, if that role does exist. And what we found is that only in the CFO role, women are better represented. What we've also identified is that there are much more male than female portfolio managers, and in previous years, and similar to previous years, where we've always found that there are more African female investment analysts than African male investment analysts. The gender mix has always been better for analysts who have in the past struggled to rise above the analyst rank and move into the portfolio management role. However, there is light at the end of the tunnel, and digging deep into our data, we are beginning to see that a change happening in the sector, and that women are beginning to make big inroads within the sector. And this may be the case because gender lens investing is beginning to take center stage. And so hopefully we expect this trend to continue. An interesting statistic, if you look at the top right graph there, you'll see that within Black-owned, managed and controlled asset management firms, white male portfolio managers continue to dominate the sector. We also generally receive a lot of interest from asset owners on trying to understand what gender lens investing is, how to practically invest with a gender lens, what types of investment strategies focus on gender equality or have the ability to implement a gender lens. So in a separate educational segment, we recently contributed to the Batseta Blue Couch initiative, where we discuss the 4 key entry points to gender lens investing in both public and private markets. So you may want to take a look at that initiative. And we summarize it quite cleanly into 4 entry points. 1, providing access to capital to businesses owned and led by women. 2, investing in businesses with activities which are responsive to the needs of women. 3, using active stewardship to advance gender diversity, voting and engagement, through voting and engagement. And lastly, investing with women-owned and led fund managers. And simply put, to the industry out there, we believe that one needs to be deliberate when it comes to the incorporation of gender factors into investment decisions. And this means that you have to basically be intentional when pursuing a gender lens investment strategy. So I'd like to end off with, and this is also one of my big pastimes, where we can talk about some of the key trends that we are witnessing on the ground before handing over to Rory to cover private markets investments. And in this year's survey, we also did a detailed study of the 4 stock exchanges now in South Africa. There are 4 stock exchanges in South Africa currently licensed to operate as such by the Financial Sector Conduct Authority. And whilst most mainstream asset managers currently largely trade on the Johannesburg Stock Exchange, what we found very interesting was that some of the niche offerings of the other exchanges are beginning to cater for interesting and alternative sources of return, and should, we believe, start playing a much more prominent role in our sector. So a big trend globally has been, for example, the tokenization of alternative assets, which is the process of creating kind of a digital representation of a non-digital asset. And it could be anything from shares and bonds to real tangible assets such as real estate or art or even sports teams. And this tokenization really seeks to address some of the challenges that investors face of not being able to gain access and broadening access to different types of investment opportunities. So the recent listing of private equity firm Altvest Capital on the Cape Town Stock Exchange, providing fractional ownership in alternative assets is a nice example of this at play. And we believe that we would continue to see an increase in such initiatives given investor demand for better access to alternative sources of return. We're also increasingly seeing investors seeking the democratization of private assets, seeking opportunities to invest in sectors that are not easily accessible through the JSE or other exchanges, and may potentially go that way. So, for example, if we look at the investment in infrastructure across all asset categories being increased to that 45%, we find that maybe the architecture of access to markets is not that easy and may require an overhaul and a revisit. And you know, we're not behind in that case, but recently the United Kingdom looked at this in a very clever way and introduced a regulated solution to be able to provide regulated access to long-term illiquid assets such as venture capital, private equity, private debt, real estate. And so, these are all positive moves, and we believe that South Africa will also trend in that direction. We, for example, are listing Africa's first Islamic sukuk on the Johannesburg Stock Exchange on the later this month. It's a 10 billion rand program providing investors access to debt funding, providing investors access to a debt solution, which is ultimately lending on to farmers or investment opportunities in the agriculture value chain. So we know that we're going to see a lot more of these type of instruments coming to market. We're also seeing a big demand for non-financial alpha, meaning that optimizing risk and return are no longer the only investment objectives for investors, from sustainability and impact outcomes to integrating unique client requirements, tailoring solutions, understanding how clients want to be serviced, and it really requires that rethink of the traditional model of asset management to one that shifts away from pushing commoditized products to crafting more client-led solutions. I want to end off with a note around what is keeping a lot of the asset managers awake at night, and it really is the ease of doing business, which has rapidly declined in recent years. And of course, we know that the biggest near-term risk is that of the grey listing, and the consequences of that could be detrimental to our sector, which means that it could add more of a burden by counterparties and increase costs for compliance. So we've got to be aware of that. And on that note, I will leave it here. I'd like to also stress that I've only touched the surface of the research content included in this year's survey, and I'm very confident that you will find our findings incredibly valuable, regardless of where in the value chain you sit. Thank you so much for listening, and I will return back following Rory's session to answer some of your questions. So Rory, over to you.
Thanks very much, Fatima. You should all be seeing the private markets slide now. I hope that's coming through. So I think the broader themes that Fatima has been talking to of the market developments are also applicable in the private markets. I think the kind of a main talking point at the moment has been the shift in Regulation 28, and the main points that are relevant into private markets investors has first of all been that unbundling of private equity and hedge funds. Private equity has now got its own line in Reg 28, and its own limit has been increased from 10% to 15%. And then secondly, the point that Fatima has touched on, which was around the infrastructure limits being brought in for the first time, which is a very interesting development. There wasn't a limit before, but it clearly shows that there's an emphasis on investment in infrastructure. And we can take both of these signals, both of the private equity and the infrastructure element, to show that from a regulatory point of view and a policy point of view, there's comfort in these kinds of investments forming part of retirement fund portfolios, which is very positive for what's still a very small part of the general allocations from our savings pool domestically. So in the survey this year, the respondents reported 33 billion rands worth of capital that has been raised across all of their funds. These are since inception numbers, so it's not the current capital that's in place, but across time, the respondents in the survey reported that they had raised 36 funds, totaling 33 billion rands. There has been some evolution in the way that these fund managers work. I think if we go back over time, the kind of initial round of black private equity funds were more focused on more BEE transactions. They often had partnerships with other private equity funds or other parties where they were almost partnering to form the BEE component for transactions. I think that's something that has diminished over time. If you look back in our survey, you would see that's been a decreasing trend. I think the next generation was much more focused on mid-market investing, more standalone type investing, and became more active. So we went from a situation where investors were initially a lot more passive and perhaps relying on other parties to invest alongside to do some of the investment heavy lifting. But this has become a lot more active as the skills base has grown. And the fund managers have sort of gained more traction and more confidence in the space. It's become much more of a mid-market place, investing in mid-sized companies domestically. What we've also seen, with not only with the change in Reg 28, but more generally just for market opportunities, we've seen the emergence of infrastructure strategies come through, and you can see that has been a significant uptick in this year's survey as well. That's not only kind of physical infrastructure, it's also increasingly digital infrastructure and other types of economic infrastructure that helps for the economy to rest on. And I think in that case, it's been particularly helpful that the definition of regulation in the new Regulation 28 of what infrastructure actually is has become quite a wide one. It's been helpful for the support of these different types of strategies. In general, we are seeing also more specialization. We've seen the emergence of more players on the early stage side, so venture capital. We've seen the emergence of particular industry specific funds, and then more niche sort of strategies such as secondaries and turnarounds. But I think this is all a sign that it's an evolving maturity. It's got a long way to run, but there's a lot more specialization that's coming into the space. I think what's also interesting to note from here is that I think there's an assumption that most respondents, most Black private equity funds are kind of busy with their first funds. That's true in a lot of cases, but we did see that 38% of our respondents are actually currently on their subsequent funds, so they're no longer on their first funds. And for those of you familiar with the space will know that these are relatively long-term investments. They tend to be 10-year life or longer funds. So it takes a long time for these to work through the fund cycles and for this to evolve. So it's very encouraging that 38% have actually gotten beyond that first fund and are investing subsequent funds. We can see that maturity also growing in the number of deals and exits that are happening. Each time we report these numbers year after year, you can see more deals taking place and crucially, more exits. So I think one of the criticisms of the space has often been, you haven't shown us the full cycle yet. You haven't actually exited the investments. That is a matter of time to some extent. And, it's good to see more exits coming through. If we're looking at the way that the market is supporting Black private markets fund managers, and in most cases, private equity fund managers, I think what's been consistent every year we've done the survey is that fundraising is the biggest challenge. I think what kind of ties into that is that track record to be able to prove to your potential investors that you have skill and the right sort of team to execute in a space goes alongside that fundraising element. But equally, because of the long fundraising cycles, the working capital for the team becomes important because until capital is raised, there's no fees to support the team. And so it's almost, all of these issues are actually tied up together. Similarly with, building pipeline, it tends to be a chicken and an egg situation. If you've got the capital, it's much easier to be credible as a fund manager who can actually execute on pipeline. But without pipeline that's credible, it's difficult to actually raise your capital. So there are a lot of dependencies within the system that contribute to that fundraising item being every year being number one challenge for Black fund managers. What is encouraging is that most respondents do say that regulation is actually supportive for them and supportive for the development of new fund managers. But hand in hand with that goes the fact that 90% of our respondents say that there is a need for incubation. So they're saying that the regulatory environment helps them to get there, but in order for them to actually be successful, there is a need for incubation programs to fill that supporting element. Similar to what Fatima said, the main issues, the main sort of macro issues that keep our fund managers awake at night are the things that keep all of us awake. That there's low growth, it's difficult political environment, a lot of political risk, and policy uncertainty. Those are the things that make it difficult to make long-term investments, and those are everything that sits in the private market space is long-term investment. So those are the macro issues that these fund managers must grapple with. A couple other points to touch on is that interestingly, more than the half of the respondents this year said that some of their investors or their LPs have played an incubation role in their fund, which is a significant increase on the previous year, and something that's quite encouraging. And then also, another encouraging point is that there was, the numbers of respondents who said that they are able to compete fairly against, other private equity fund managers in the market has continued to grow, and that is at 86% this year. So there is a leveling of the playing field that has been happening, and it's very encouraging to see. Onto how the teams actually look. If we look at what a median team looks like in the space, it's made up of two principals, an associate, an analyst, and two supporting staff. So these are relatively small teams, but that's kind of the median team. There are some exceptions. Those fund managers that are attached to larger organizations often have a lot more support staff, that'll help them, for example, on a lot of the back office work, and there might be a sharing of resources even with some of the front office teams. But for standalone fund managers, that median team is a pretty accurate representation of what most teams look like once they are actually operating. When they're fundraising, their team tend to perhaps would be just the principals and maybe one supporting person, and then once they raise capital, then they start to build out those teams. Just on some of the economics, which are very important to a lot of the fund managers, what's required of private equity fund managers is to put in some capital alongside their investors. This is in most instances, this is around 1%, but what investors do expect to see over time is that trends upwards. And that's what we're seeing, just slightly that trend happening in the numbers coming through, is that as fund managers get onto subsequent funds past their first funds, they are expected to plow some of their success in an earlier fund into the new funds as they go forward. And then last point here, just on the management fee, I think across all asset classes, there's pressure on management fees, and we are seeing a shift happening in private markets, which has been a very kind of stubborn place for fees. And we can see that actually now most fund managers have actually shifted to offering fees that are less than the classic 2% management fee. So we have seen a contraction in that over time start to happen. And this year was probably the biggest shift that we've seen in that space. Fatima talked to the gender lens. This is equally, a lot of the points that she made are equally applicable here in private markets. So we We see in total in private markets that there are actually more women employed than men. So if we look at including support teams, it's actually 54% female. So everything looks good at the top level. I think where there's further improvement to be made is where we go into investment teams, where we actually see that 62% of staff are male. And then we also see this playing out in the senior positions in these organizations, where particularly the CEO, CIO, and investor relations are actually dominated by men. The CFO to a lesser extent. We see in many instances where there are two male founders, for example, then the CFO coming into the team will often be a woman. So there's a bit more balance there. But you can see in general that typically these key positions are most often taken by Black males across these funds. If we look at, there's been a shift in the way that the way that these teams operate, mainly or in a lot of cases driven by the impact of COVID-19 and the lockdowns that we all experienced. I think given that most of these teams are smaller and just made up of a few professionals, I think it was relatively easy for them to shift to remote working. And I think in the earlier days of the pandemic, we saw that some did give up their office space, many reduced office space. This has settled down a little bit to the point now where it's clear that each of these firms are keeping their office space, but they are in many cases reducing. They're taking and they're working in a more hybrid way. I think some of the worries that were in place early on that might lead to staff reductions haven't really played out. These teams, require the resources that they require to operate the funds, and they haven't. So we haven't seen those staff reductions, but we have seen remaining flexibility in the way that employees work. Even if it has sort of decreased a little bit from the highs of the COVID pandemic. When we look at the impact and the way that teams work, we asked about how it's impacting these teams from a mental health perspective, from the point of view of innovation, communication, collaboration, productivity. What we are seeing is that what's come through in this year particularly is that there is a mental health hangover that's come through from the COVID period. We know many of the teams operating in the space lost family members and sometimes team members, and I think we can't underestimate the mental impact of the last couple of years on these teams, and we are seeing that in the numbers. That said, there have been some positives, and I think if you look at the red blocks in the bottom chart. In general, there's the respondents to our survey saw a lot of positives in the impact of the way that their teams were working. Those are all where respondents are seeing actually better results than they were seeing before COVID. So in the areas of collaboration and communication, I think we've all worked out better ways to do things, and these hybrid situations are something that the Black private equity managers are actually managing to handle. I think the one thing that has dropped off a bit is those initial productivity gains that we saw from remote work, where there was a lot of focus. In the normalization of society, some of that productivity gain has gone away, but it's still indicated as better than what was in place previously. Some points to make on the fundraising side. I said earlier that this is the number one issue that Black private equity fund managers face. There have been some positive moves here. You will see that mostly capital is raised from local sources. And there was one fund manager in our survey that managed to raise the majority of their funds from offshore development finance institutions. But in general, that channel hasn't really been open for Black private equity funds, and even more broadly, any South African private equity funds has been a difficult fundraising environment globally. So you can see that we highlight the change in receptiveness of the different investor groups. The only one that has been negative over the last 2 years has been the offshore funding component. And you see quite positive moves from local pension funds and their asset consultants, significantly positive moves, coming through. And also, the emergence of other local investor groups outside of those, and positive reception that these private equity fund managers get from these different groups. So all of that is quite positive, and in many instances is actually translated into improved fundraising. What we can say is also that having Black manager support programs, incubation programs, remains extremely important. And that came through in what was said in a previous slide as well, where fund managers continue to report that that's extremely important for them. They see it as an important part of the development of the industry. What is also nice to see is that as funds manage to go through the different fund vintages, so when they go from Fund 1 to Fund 2 and to Fund 3, we do see increases. We do see more successful fundraisers. So that's both from the perspective of having more investors and also from having higher total rands of capital raised. So you can see that in the bottom chart, that we do report that evolution. From a branding position, I think the fund managers, continue to believe that performance, that financial performance is the number one driver of their brand. And, I think we would agree with that over the longer term. But we would say that it takes a long time for that to play out. In a private equity sense or private market sense, these are all long-term investments. And so, success is something that's achieved, normally, over more of a decade. So it takes a long time for that to actually impact brand, especially for new fund managers. We've seen the increasing emergence of impact as a brand driver, and that's probably the significant change that we saw, or the significant increase that we saw in this year's survey compared to previous ones. The increasing recognition that impact actually drives brand positioning. From our own perspective as investors in the space, I think the things that we find that impact how we see the brand positioning of these different fund managers is actually more in the middle of this table. Differentiated product, the values of the fund manager, and the experience of investing in the funds. Those are the kind of the nearer term things that we see as impacting the brand positioning. And that's something that we focus on with the different fund managers that we back in the space. We can say that all of the fund managers who responded to the survey are members of SAVCA, and that continues to be the industry body of choice, and they do align to the codes of conduct and the different standards, for example, valuation standards that are applicable to SAVCA members. So that remains the channel for all of these fund managers. We also note that from an advertising and a sort of a visibility point of view, we see that a lot of fund managers don't do any advertising. So there's often they're flying below the radar. And many fund managers don't actually report kind of even all of their events that they have. So fund closes, the deals that they do when they exit, and other significant announcements. Those are all opportunities for brand building for these entities. But so we think there's, I think we made this point in last year's survey, but we make it again, that there are more opportunities for these fund managers to actually get brand visibility, and something we always encourage them to do. I think despite the fact that we have seen a shift in fees, a downward shift in fees, low fees is not considered really by the market as a strategy for brand positioning. Fatima mentioned ESG and impact when dealing with the listed market. And I think on the unlisted side, I think there's a longer history of private equity funds adopting and ingraining ESG principles into their investment strategy. Where we've seen a lot more of a shift is on the purely on the impact side. So where ESG principles are used for risk management and opportunity identification, in investment decision making, impact is becoming increasingly important. We're particularly seeing this in the areas of job creation and transformation, where there's a big opportunity for these fund managers to make a difference in the companies that they invest in. So 67% of the survey respondents said that in all their investments they've had so far, they've had a positive impact on employment. So they've left companies with more jobs than they had prior to investing. Some of them didn't keep the necessary records to be able to say, but the vast majority were saying that their investments are creating employment. And similarly with transformation, these private equity fund managers are leaving their portfolio companies with better BEE ratings than when they found them. It's also encouraging to see that managers were increasingly willing to formalize commitments around impact into their agreements with investors. So that means if there were particular requirements, such as investing in areas which might create jobs or meeting certain transformation requirements or reporting requirements or any other type of impact standards, that's something that fund managers are open to looking at and contracting for. So I think it's been an evolving space. There's a number of positives to flag in this year's survey, and I think over the 5 years that I've been involved in the survey, there's been a quite a dramatic improvement in the quality of the fund managers that are operating in the space and the options for investors. So what we're expecting with the shift in Regulation 28 now, and the continued focus on transformation, we do expect more positive developments for the Black private equity manager space. Thanks.